Good day, fellow investors. HPE is down, also HPQ. So let's dig and analyze. So we have now HPE P ratio of 744, dividend yield 3.39, and there have been plenty of comments. What's going on? Uniper acquisition. Why is the stock down? Is it cheap with a P ratio of 7? And what's my intrinsic value? Let's look into the business. So they have tariffs now, aggressive competitive pricing, which has lowered gross margin by I think 6%. But that is also the issue I have with artificial intelligence. We don't yet know what are the prices, what is the long-term outlook for that. Now we have huge investments, but there is also competitive supply, then that leads to volatile margins and profits, and we don't know what will be the return on investment for AI. This is also the uncertainty now in the market, and on top of that we also have Department of Justice going against the Uniper 14 billion all cash deal. So we'll see how that works out for the company, but then again, this is also something that adds, doubles, triples the risks, because they will do it with cash, more debt, more interest on, again, an uncertain margin situation, even if they do it. Let's check the earnings and discuss what's going on. How is there a P ratio of 7? That we'll see it's not 7 because gross margins are going down. They are investing in all kinds of things. Of course, AI, cloud, and things like that. But if I look at free cash flow, they are expecting to generate 1 billion of free cash flow in 2025. 1 billion on the market cap of 20 billion, that's a P ratio of 20, not 7. And I have read some analysis discussing how HPE is the cheapest in the AI environment. Yes, compared to all the other even more exuberantly priced competitors. But if I look at the outlook, nothing stellar here, and then it will depend on the cycle there. But we are now at peak cycle, we are now in a booming environment, and we already see margins crashing, which means that is a very risky situation on top of an all cash transaction of 14 billion going into, again, something that is, again, not really an easily, let's say, return on investment discussion. So I'll put this HPE on a too hard pile. I've done this already, I think 2 years ago when we analyzed it, or 3 even, but it's simply hard for me to see where to put this, or to see that I know for sure 2 years from now or 3 years from now revenues will be 50% up, profits will be 2 billion, not 1 billion. It's very hard to see. It is possible, profits might even be 3 billion on the AI jump and everything, but it's simply too risky to see. And I know that on the other hand, when it gets ugly in this environment, it's really ugly. Perhaps something better in HP, P ratio of 10, dividend yield of 4%. Let's look at the earnings. Stable earnings, stable Q1. Also, the outlook is for stability. Printer a little bit declining, but computers and personal segment, okay, doing the key there. They are also investing AI systems, this and that. It's not miracles, it's still HP, but they have a good position in the market. They do have 10 billion of gross debt that with higher interest rates might also bite over time. But if we look at cash flows are really high, 3 billion free cash flow for the year, and also expected free cash flows even higher next year. 3 billion compared to the market cap, that's still a very, very good double-digit free cash flow yield. But if we look at the numbers, we see that inventories are going high from 12%, 13% to almost 16%. And this is again a cyclical industry where if you're selling less computers, those computers age, there might be inventory write down, so 8 billion might go to, I don't know, 6 billion, what they can sell over time. So this is also a huge risks there. And you see here the inventory days, the yellow line going from 57 to 72, which shows this is really a big deal when it comes to businesses, and which shows also that the business is cyclical. For now, everything looks good, sales are okay, margins are okay, free cash flows great, because compared to other companies, we have a 12, 13, 14% free cash flow yield, good dividend, buybacks, shareholder rewards. But when it comes to these businesses, I know how ugly it can get when things get ugly. Companies delay buying new computers and things like that, margins are squeezed, and then it looks really ugly. And I prefer that the ugly is already there when it comes to the business, or that I'm in a position that whatever happens, I know I'll get to a positive return. And when we look at our value investment quadrant, I know that 2 years from now, no matter what happens, you will likely eat, you will likely buy your things, there will be significant demand for food, and then I can ride up that cycle. And especially when there is already a downturn, then I prefer watching, because I know I have a margin of safety. If we are, let's say, here on computers, HPE, HPQ, I don't want to play this. I follow a lot of companies, and I just need a few that are already here, where what is left is, I don't know, a 4% dividend if the market doesn't reward me, and then if and when there is an upside, I get the upside too. So I think we are here mid-cycle. We haven't yet seen the ugly with HPQ. Of course, doesn't mean we have to go to a bottom. We can simply stay here and go higher. If you want another 10 companies like this one and better, check my research platform. There you have it. You can check everything, 21-day money-back guarantee. Building a long-term value investing portfolio is what I do. HPE, HPQ, unlikely that they will meet those requirements over time. Thanks for watching. I'll see you in the next video.